Today we're going to talk about momentum stocks, what they are, and why you should care. I mean, listen, you're trading with a small account, or in my opinion, a medium or even a large account, this is where it's at. Boring, sideways stocks are the worst. I'd rather have like a dripping faucet when I was trying to sleep than trade sideways stocks. We love momentum stocks. Today we're going to talk about it. Hey everyone, lead trainer with Stocks to Trade, Tim Bowen here. Be sure to like, subscribe, and ring that bell to be notified as soon as we go live. We do so much on this channel, really proud of it. How-to videos like this, long-form podcasts, the short twist podcast. Bryce is doing kind of the funny, irreverent, steady trade treats. I go live every day. I mean, it's pretty wild. Here, a few years in, 3-4 years in, the amount of stuff we put on the YouTube channel, really proud of it. Ring that bell, subscribe, share with your friends, and also check out the Steady Trade team. It's a mentorship program where I've done over 2,500 webinars. I think it's the best way to learn how to run these scans, learn how to spot these patterns, learn how to really master this niche. Click that link, and I look forward to working with you in a small group. All right, momentum stocks. What are momentum stocks? Why do we care? What are some of the drawbacks, etc.? So, I mean, you can see a great example from today, GTech. This ultimately ended up being a failed dip and rip, but you can still see the potential. I mean, the news dropped at 7 a.m., and I mean, look at this thing. I mean, you had to be quick. You had to be really quick, but you see the potential. News drops at 7 a.m., stock goes from 8 to as high as 27 in pre-market, pulls back to VWAP, and then spiked all the way back up to 27 in pre-market again. I was looking at that dip and rip. You can see it opened weak, never bounced. But the beauty of the 945 rule, which if you guys know the 945 rule, keeps you out of a lot of trouble on these stocks. But I'm just getting at the potential. You know, here it is. This stock's basically at the low of the day at 3 p.m., and it's still up 100%. So, and bring up GTech. I'm recording on the middle of February. Bring up GTEC. Wouldn't surprise me if this thing made another run. But that shows you the potential. And now let's talk about what to look for, why we care, etc. So ultimately, with a momentum stock, it can look like there's no top in sight. I mean, that's what I call that blue sky chart. And we love those blue sky charts because at the end of the day, you'll hear bag holder charts. It's a term I use a lot. You'll hear other people doing videos and they'll say, oh, it's a bag holder chart. The idea behind a bag holder chart is it's that long-term downtrending chart that just has that weak bounce. And ultimately, you've got all of these people that are upside down. I mean, you've probably been there. I mean, we've all been there. So, you know, hopefully we learn from it. But you bought some stock and it just read every day, and you hold and you hold and you hold. You quit opening your brokerage account because you can't even bear to look at it. Then one day, 6 months later, your buddy texts you and he's like, hey, your bag holder stock's up 30% today. Now, you're still bleeding in the red. You know, you're down 80%, but your buddy tells you about that 30% bounce, and you're like, hallelujah, you sell, okay? That's what creates that one and done chart. It's because every bag holder is like, thank goodness I got a 30% bounce. I didn't run my account all the way to zero. What's great about stocks like GTech or these other 52-week breakouts, it's all blue sky above. That's why we love the IPOs. We love the SPACs, the special purpose acquisition companies, because most of the time they're in hot sectors. I mean, that's the perfect thing about IPOs. I mean, here's a tip. Obviously, if you're taking your company public, you're probably not watching my videos, but just think about it. If you were going to do an IPO, are you going to do an IPO in a boring line of business that no one cares about? No, you do your IPO like, you know, in 2020 when electric vehicles are going wild, or you're doing a Bitcoin IPO, or you're doing a coronavirus IPO. I mean, you're going to time your IPO around hot sectors. Then that stock opens up. You got all the mania. It's all blue sky. You've got no bag holders above. That's why we love IPOs. We love SPACs, and we love breakouts. I mean, even if the stock's been trading for 20 or 30 or, 80 years, if it's at all-time highs, nobody's red. So everybody's buying. It's the old, it's like everybody's dancing around the punch bowl. When you're at all-time highs, everybody's happy, everybody's buying more. That's why breakouts work. So, also institutions, when you've got these real stocks that we talk about, a $50 stock, $100 stocks that have decent financials. A lot of these I'm talking about aren't the penny stock, the low float, the junk stocks. But right now in this market, even the higher price, the quote unquote real stocks move. And especially if they're profitable, they've got real products. You've got, you got retirement funds, mutual funds, hedge funds, retirement funds, etc., pensions, etc. Adding to these companies creates buyers. The more buyers you have, the better. So I already talked about the fact that most of the time they're in hot sectors. Most of the time they're sympathy plays. I mean, right now, Bitcoin hit 52,000 last night. We had Riot, Mara, some of these most beat down stocks ever, all at 52-week highs. Everyone's talking about them. And at the end of the day, more buyers. Remember, the stock market, and you'll hear me say this on so many videos, but the stock market is a market. Supply, and what rules markets? I don't care if you're selling coffee or water or bananas or apples. More buyers means higher potential for the price to go higher. Concert tickets, great example. I mean, if it's a hot concert, you aren't paying face value. You're not paying $50 for the latest hot concert. You might be paying $500. Who knows? Day before the concert, you might pay $5,000. That's what we want. More buyers, more demand, etc. Now, what are the downsides? I mean, at the end of the day, these stocks are, quote unquote, up a lot. Okay. I mentioned Riot. That was a stock for years and years. This is a $4 to $5 stock. It hit 85 last night. So it's a double-edged sword. I went on and on about how everybody's in the green dancing around the punch bowl. But at the same time, if you're that buyer that bought at 4, or bought at 5, or bought at 10, or bought at 20, and now you're at 80, 90, maybe there's going to be some profit taking. That's the beauty of having a plan, okay? If you check out the Steady Trade team, you'll hear me say it every single webinar. You're not trading unless you have a stop loss based on the chart and a goal based on the chart, okay? So if you're trading with a plan, with a clearly defined stop, then if the profit taking comes in, you stop out, and you move on to the next one. Small losses, big gains over time, you're a consistently profitable trader. One of the biggest drawbacks, and I suffer from this terribly, momentum stocks move fast. They move up fast, they move down fast, and I spend more time at this computer than I care to admit. Probably an unhealthy amount of time. I get up at 4:30 in the morning, I get some coffee, but usually I'm at this computer a little after 5 in the morning, and I take breaks, which you should too, but until that 4 p.m. close, I'm staring at this thing because I trade some of the most volatile stocks, and that's 11 hours a day staring at this computer. I don't know how healthy that is. I'm almost 50 now. I haven't dropped dead yet, but that is a drawback. If you've got a job, if you've got kids, if you've got commitment, it's tough to leave the computer. That definitely is a drawback. And then ultimately, at some time, when that air comes out, this kind of dovetails back to the last point. When the air comes about, they tend to fall fast. And if you can't take that loss, taking losses is discipline. That's why so many newer traders fail. They haven't built up the discipline to take that loss. Okay. And if you haven't built that discipline bone, check out Jocko Willink, watch the Jocko podcast if you need to build your discipline for free. But if you haven't built that discipline, when they start pulling back and they blow through your stop and you start justifying and you start adding to a loser, it can get ugly real fast. So that's the biggest drawback, is that stare at them all day, and if you don't have the discipline to stick to your plan, it can get ugly fast. All right, I hate to finish on a kind of a dour note, but ultimately what I try and do with the podcast, what I try and do with these videos is, I want you eyes wide open. Listen, market's wild, so much going on, so much opportunity out there, but go in knowing what the risks are, knowing what bad can happen. I mean, think about a battle plan, or a fight. I mean, the famous Mike Tyson quote, everyone has a plan until they get punched in the face. Okay. You got to have a plan if that right cross hits you. Okay. Because if you start freaking out and losing it, it's going to get ugly. It's going to go to the mat and it's going to get ugly real fast. So have a plan, learn that discipline, and go in eyes wide open. But that being said, I mean, G-Tech's such a great example. 8 to 27 in 10 minutes. That's the potential in these type moves. All right, everyone, have a great day. Check out the other archive of videos if anything went over your head. We've got hundreds of videos, blog posts, podcasts, and ultimately, if you're really ready to take that next step, check out the Steady Trade team, and I'll see you next time.